Alrighty, everyone. Well, I want to thank everyone first and foremost for joining with us today. We are going to be covering the Roth conversion, a very interesting strategy for moving pre-tax retirement dollars into post-tax accounts. So going from traditional to Roth, it can offer some inherent benefits, but there's definitely some drawbacks and some considerations that you need to be aware of before kind of jumping into this, because this is one of those kind of tax planning things where once you do it, there is no mechanism to undo it. So once you ring the bell, you can't unring it. So today, my name is Alex Perny. I'm a business development specialist with Advanta IRA. I've been doing this same thing since 2012. I kind of started my career in the operational side of things with actually investing client funds, handling different aspects of day-to-day account management, investing for clients, and then I moved over to my current role in about 2016. So if you do have any questions, I am always certainly happy to help. My colleague Corey kind of had a similar career trajectory as myself. He's been with Advanta since 2016 and also had a long stint in business development as well. So if you have any questions that you would like to frame to us, again, not just on the functional side of these things, but if you have investment related questions as well, or how something might play into one of those aspects, do feel free to drop us a question in the chat box, because do remember that all of your audio on your end is muted. A little bit of housekeeping before I turn it over to my colleague Corey to take us through the first half of the presentation. Advanta IRA and our employees, we do not provide investment advice, nor do we endorse or promote any investment products. All information and materials are for educational purposes only, and all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment. And I would just book in that specifically what we're going to be talking about today has very real and can have potentially very large tax implications for you personally. So please do take everything that we're saying here with a trust but verify for your own personal taxable situation, because everyone is going to be unique in whether or not a Roth conversion is a good fit for you. And as I mentioned in the very beginning, this is not something that you can undo. Once you do a Roth conversion, there is no longer a mechanism for undoing that Roth conversion. So you absolutely need to be 100% sure that this is a route that you would like to take if you would like to do it. Again, once you do it, there is no going back. So again, we'll kind of just leave it on that. And with that said, I'm going to turn it over to my colleague Corey to kind of take us through the front end of Roth conversions and what you need to know from this presentation. Corey?
All right, thank you very much, Alex. And one additional quick note for the audience, if you're watching with us live as we're recording this today on Thursday, the 21st, the recording will be emailed to you, and it will also be available on our YouTube page within about 24 hours. And you could also reach out to Alex or myself if you'd like a PDF copy of the slides from today's presentation. So please feel free to contact us if you're interested in either of those contents. So just a brief history about Roth IRAs. The IRA in itself, traditional or tax-deferred IRAs, started in 1974, but the Roth IRA actually started in 1997 when a senator from Delaware named William Roth actually proposed with another senator this ability for your retirement fund to actually be post-tax and grow in a completely tax-free capacity. So while standard IRA accounts have been around since the mid-70s, the Roth IRA specifically has been around since 1997. And in 2006, they also started to allow Roth component 401ks, which is a separate animal, but similarly related, where an employer-sponsored plan can have a Roth component within it, just as well as your non-employer-sponsored IRA accounts or individual retirement arrangements that don't have to be tied to a specific pension plan or a specific employer-sponsored plan that you may be participating in, like a 401k, a 403b, a 457, those types of options. So just at a glance, a traditional IRA, anyone that has earned income can contribute into it. The deductibility of that money is based on your annual income and may be limited based on that income specifically. The benefits there are you get the tax deduction, so it can lower your current tax bill if you're within that deductibility phase. You're growing the money tax deferred, so while you do get the write-off of the amount of money you put aside each tax filing year, that money is going to grow in an account that you ultimately pay taxes on later in life. So that is something to be said, and to, again, speak with your CPA or tax preparer about as far as when is it best for you in your situation to take the tax hit for the money you're setting aside and investing. And then Former 401k plans can be rolled over with no tax consequence. This is usually called a direct rollover. Sometimes it can be done as an indirect rollover. A lot of other companies usually call their products a rollover IRA. We don't necessarily use that term in our marketing or language, but it's really just an IRA funded with a rollover from a previous employer-sponsored plan. After you've left a job, or if you're eligible for an in-service rollover and want to start self-directing those funds, that's something that you absolutely have the opportunity to do. Now, with the contribution deductibility, it's based off of your modified adjusted gross income. And I've got a chart here just kind of outlining where those deductibility phase outs lie and where your income limit would be to get that deductibility, or where you may start being phased out of that deductibility. So that's there for you. I'm not going to read every single number. That's not what we're here for, as far as like reading the actual information in front of you there. But just be aware, if your income level is within any of those brackets there, whether you're married or single, that is where your deductibility lies in regards to the contributions. Now, if you want to take distributions out of a traditional account or tax deferred account, you're going to want to wait most likely until you're age 59 and a half, so you can avoid the 10% early withdrawal penalty. And when you do take these, it's taxed at your ordinary income in a traditional account. So it just gets added to your ordinary earned income for that tax filing year when you start taking those distributions at retirement age. Once you reach age 72, I believe this is actually potentially going up to age 74 in the next cycle of legislation passed, you're required to start taking what's called required minimum distributions, or RMDs. And that is for traditional accounts. It's not for Roth accounts, because the government's already taxed you on the money you have in a Roth account. There are a few exceptions to the 10% penalty. They're outlined here: higher education expenses, disability, first-time home buyer, or inherited retirement accounts. And then specific to inherited retirement accounts, if the spouse is the beneficiary, the IRA can be treated as their own, or if the spouse is not a beneficiary, it does have to be distributed in full within about 10 years. So there are some stipulations to understand with traditional accounts that are not necessarily subject to the Roth IRA accounts and the way that they are handled, which is what we're going to actually jump into right now. So looking at a glance at the Roth IRA, very similar to the traditional, anyone with earned income can contribute into these plans. There is a contribution limit based on your income, very similar to the traditional account, where you may not be able to contribute into a Roth IRA directly, but there are some strategies that you can get money into a Roth IRA by basically contributing into a traditional and doing what's called a backdoor Roth conversion once you have the money in a qualified retirement plan. So the benefit for the Roth accounts that we really want to stress today is that the earnings are growing completely tax-free, and you have no taxation when you withdraw out of this account. There's no mandatory withdrawals at the tail end of your life expectancy, like with the required minimum distribution for the traditional accounts. And it's really good to utilize this strategy in a lower tax year than when you expect higher taxes in the future. Basically, the way I put it is that if I expect to be a high earner and generate more income year after year, I'm going to want to pay the taxes on this money now, so that later on, when my tax bracket potentially is higher and I'm a higher earner later on in life as I progress in my career, I don't want to end up paying taxes on my nest egg then. I'd rather pay it now, let it grow with me and grow with my income throughout the years, so that by the time I'm ready to retire, all of the money I'm leaning on for my retirement life is already been taxed and basically accessible to me without any additional bumps taking out of it or anything like that. So again, looking at the contribution phase out specifically, if you're a single individual and you're looking to contribute into a Roth account, if you make between $124,000 and $139,000, you're being phased out of your ability to contribute into the plan and get the appropriate taxation handled. So if you're in these brackets listed here, it's going to be up to you and your tax preparer to decide, is a backdoor Roth contribution and / Roth conversion viable for your long-term investment strategies? Or is it better just to put the money into a traditional account and leave it there? And keep in mind, if your adjusted gross income is too high, you're not going to be able to contribute to a Roth IRA at all. You'll be completely phased out. You'll just have to do it straight into a traditional account. And then, as I just said, make the decision with your tax professional if converting over to Roth is in your best interest or not. Having wrapped up the at a glance for both of those account types, I think I'm turning it back over to Alex here to define a little bit more deeper what the conversion is and how it's accomplished.
Yeah, thanks, Corey. One thing that I would book into what Corey just said on the conversion aspect is that if you are phased out from making a traditional IRA contribution, so to the point that Corey made, to kind of book in that, if you are phased out of making a Roth IRA contribution, meaning that you just can't directly put money into the Roth IRA. So then you'd have to put it into a traditional IRA. You can always do a conversion. There's no income limitation phase out for being able to do a conversion. However, when you look at the backdoor Roth contribution, as some people like to indicate on this, you do have to be aware that you are going to have to track your basis in your non-deductible traditional IRA contribution via IRS Form 8606. I'm not going to get too far into the weeds of kind of explaining, exactly what that means. Just be aware that it's maybe not necessarily as simple as maybe some of the talking heads that you might hear, in other avenues indicate. So just be aware that although you are able to do that, contribute to a traditional and convert it to a Roth, just from your contribution standpoint, it is a little bit more of a complex scenario from a tax reporting standpoint. So again, just like to make sure that that is posed out there. We did have one question I want to address. It is a little bit of an easy housekeeping one. It says, is the self-directed IRA considered a traditional IRA? Well, self-directed in and of itself as a term is basically a marketing term. A IRA is an IRA no matter where it is. Where we use the term self-directed IRA is just simply indicating the types of investments that we allow for our clients to do. So you can have a self-directed traditional, you can have a self-directed Roth, you can also have a self-directed SEP simple or solo 401k. So there's all sorts of different types of self-directed accounts you can have. The indication of it being pre or post tax is the important part. So let's take a look. So what is a conversion? On face value, it is taking pre-tax retirement plan assets and moving them into an after-tax retirement plan. So think your traditional IRA, think your SEP IRA, your simple IRA, and also 401ks can do Roth conversions. When we talk about a Roth conversion, it simply means going from one of those pre-tax plans into an after-tax, Roth type plan. So again, knowing the definition of it is kind of an important avenue to at least start with this. Now, when you go from a pre-tax to a post-tax retirement plan, you are going to be taxed on the entirety of that value that moves from one plan to another. And Corey will get into a little bit of when I'd say value specifically instead of just dollar amounts, because you don't just have to convert cash. You can do what's called an in-kind conversion, meaning converting an asset. And that kind of has its own things to be cognizant of if you go forward from that. But at its face value, you move funds from a pre-tax retirement plan into an after-tax plan. And you're electing to pay the taxes now in the year in which you do the conversion. And that's why we're doing this presentation today, is that you have to do a conversion from January 1 to December 31st in order for it to be counted in that tax year. There's no such thing as doing a previous year Roth conversion. And as I said, you can't undo a Roth conversion as well. So you need to be very certain in your ability and desire to do one in that scenario. Also keep in mind that this is going to basically adjust your modified adjusted gross income up by whatever amount that you convert. So while yes, you maybe have business losses or you have other types of losses that might help to offset income in a certain sense, the type of income that this is going to generate for you may not necessarily be offset by some types of deductions. So again, it's very important to talk to a CPA or a tax planner to make sure if you're going to be taking in a significant amount of additional income via a Roth conversion, you're not just going to get hammered with taxes and then not only have to make up the tax bill, but also the applicable earnings that might have been offset between moving from pre-tax to post-tax. So again, there's some definite considerations to consider when actually thinking about what you really want to do when it comes to converting from a traditional to a Roth. Okay, so Roth conversions, again, have to be done within a certain calendar year. And there is no adjusted gross income limit for converting from a pre-tax to a post-tax retirement plan. I do get that, question fairly often saying, oh, well, I can't contribute to a Roth IRA. I can't do a conversion. There is nothing like that. So long as you can stomach the amount of additional income coming to you in that given year, you can do a Roth conversion of as much value as you like, and you can have made as much money as you possibly could in a given year. So whether you made $10,000 or 10 million, you can always do a Roth conversion, which is a very important thing to bear in mind. Now, yes, there were some tax legislations that came up that proposed phasing out the Roth conversion limitations, but all of those failed in committee. So while some people may say, oh, well, I thought X or Y, and you might have seen that this was on the table. Presently, there is no current active legislation that has any aim towards reducing or eliminating any taxpayer's ability to do a Roth conversion. Now, Roth conversions are always done at a fair market value basis. So it's easy enough to say that, okay, I convert $10 of pre-tax to post-tax, I get a $10 1099. Well, when it gets to be a little bit more complex is when you start talking about conversions of assets, and we'll get into that a little bit later. But keep in mind that you always convert at a verifiable value. And there certainly could be some tax strategies when it comes to certain assets, and you don't necessarily have to do the assets in their entirety. So if you want to do a portion of your cash in one year and then a portion next year, if you want to do a portion of an asset, if it can be bifurcated, then you certainly can do that as well. I'm presently working on a client that has a single member LLC in their IRA that we're doing a conversion of a portion of the membership before December 31st. And then we're going to do another one afterwards. So again, there's a lot of different strategies that kind of go into this, but in general, the rules related to this is that you are going to potentially see a bump in your tax bracket, because when you're talking about converting 50, 100, $200,000 worth of retirement plan assets, that certainly has the ability to stretch you into additional tax brackets. And keep in mind that because you're showing additional income in that given year, this additional income has had no federal tax withholding taken out of it. It has not had Medicare, Medicaid, any other type of taxes. So because of your adjustment into potentially higher tax bracket, you're going to have a large block of value that has had no withholding taken out of it. So your potential personal tax liability could be substantial. Okay, I got a question. I think it's good enough time to answer it. It's a pretty good one. Let's say Advanta holds for me real estate asset in my traditional IRA that has a fair market value of 100 grand. I want to move that asset into a Roth. I assume that I would have to pay taxes on the $100,000. Then I sell the asset, let's say next month for 200. Do I owe additional taxes on the extra? No, you wouldn't. Essentially, you have converted an asset. Now it does have to be a certified appraisal of that property. If it's a piece of real estate, we would require a certified appraisal. So if you had the ability to sell it for 200 and you convert at 100,000, whatever that may mean, I would just put it out there saying, the value would probably reflect a little bit of that. But let's say that scenario does play out. $100,000 of appraised value on the property, you convert it, you get $100,000 of additional tax bill in that given year. You turn around and sell that for 200 grand. Hats off to you. I applaud you for that strategy. That you would not owe any additional taxes on that. On the sale of that asset. It would just go directly back into the Roth IRA without any additional tax liability being a burden to you. Just the IRA would now have $200,000 in it. So yeah, that certainly would work. Let me make sure we're at the bottom. Okay, great. Okay, I think I am. Okay, here's some additional rules. When you do a Roth conversion, it is reported on IRS tax form 1099-R. It looks like you did a distribution, but there is a correct coding that you use in box 7 to indicate that there is a known exception. And when we file the IRS form 5498, that will essentially remove any type of 10% early withdrawal penalty that might be shown from taking an early distribution if you're under the age of 59 and a half. So keep in mind that Roth IRAs, while yes, you do owe taxes, there is no penalty associated from doing it. It is looked at from the IRS's standpoint as a reported distribution of assets, but the applicable tax reporting that's done on the Advanta side of things would help to offset any of that. Now, Roth conversions do not And I repeat, do not apply to your contribution. So you could do a $100,000 Roth conversion and still be able to make your annual contribution. That does not phase you out of being able to make a contribution. Now, there are some definite rules with regard to doing conversions and being able to take advantage of all of the great benefits that we know and love from Roth IRAs. So a Roth IRA, in order to be able to distribute your earnings tax and penalty free, the account, or you have to have at least had a Roth IRA in existence for at least 5 years. And you also have to be of the age of 59 and a half. Now, there's some other interesting caveats to this is that Roth IRAs, your contributions are going to be considered basis. But if you're under the age of 59 and a half and you convert your pre-tax assets, you have to wait 5 years. If you didn't, you have to wait 5 years for that converted amount to be considered basis. So while in the normal course, people think, oh, I can access part of my Roth retirement plan tax-free at any time, it's just the earnings I have to be aware of. If you're under 59 and a half, that converted amount has a 5-year clock that you have to run off before you can treat it as basis for the purposes of distributing tax and penalty free. Now, the 10% early withdrawal penalty does get removed from Roth IRA assets if you are distributing for higher education expenses, disability, first-time home buyers, and inherited IRAs. But you also, again, with Roth IRAs, you do get a little bit more complex insofar as that you have to track your basis and the net earnings attributable to different potential basis buckets, meaning that if you do multiple conversions and you're under the age of 59 and a half, you have to track each bucket of basis. So here's an example. In 1 year, you did a $10,000 conversion. Subsequent year, you did another $10,000 conversion. And let's say in the following year, you did another one. You would have to track each one of those aging for 5 years and also track the earnings associated with each $10,000 bucket to make sure that if you do take an early distribution from the Roth IRA, that you would be paying any applicable taxes and penalties in the correct order that you needed to. But once you do reach the age of 59 and a half, the only thing that you have to be aware of is at least having the account open for 5 years. And then once the account is open for 5 years, any earnings associated with any conversions within that plan, those are the only things that have to age. Then your basis is automatically considered vested when you do a conversion after 59 and a half. And remember, when you do a distribution from a Roth IRA, you always distribute your basis first. So contributions are distributed on a FIFO rule, meaning first in, first out. And then conversions are distributed second. And remember, they have their own 5-year rule. So this kind of plays into strategy for someone saying, hey, look, especially for those individuals that are getting close to required minimum distribution age that might be using this as a tool to remove the RMD requirement, is that you might have some restrictions if you haven't had Roth IRAs open in the past from accessing some of that money. So it's not just as clean cut as saying, hey, I can stomach the taxes, I can convert to a Roth IRA. You really need to look at what your ultimate strategy is. If you're not looking to touch this stuff until well into retirement, what I'm saying is kind of a moot point, because if you're 10, 15, 20, 30 years down the road, that's all well and good. This stuff's going to age out and it's not going to matter. But especially for those individuals that maybe are of 59 and a half, or maybe you're getting close to required minimum distribution age, or maybe you want to start drawing some of the funds out of these things, you really need to be aware of the back end consequences of how you can actually access Roth IRA funds without having additional 10% penalties and potential taxes on any earnings being distributed out of that plan as well. Let's see. I got a question. Do beneficiaries get step up for both Roth and traditional IRAs? I would need more context on your question about step up basis for that. Are you talking about the perspective of doing probate and potential inherited taxes? Because essentially the step up basis for this doesn't really have much of an application due to the change in beneficiary distribution rules that were enacted after 2020. So maybe give a little bit more context to that, and I can certainly circle back on that question. Okay, so why convert to a Roth IRA? You expect larger returns on investments in future years. Ideally, just as the one gentleman asked previously, if you converted 100,000 and you sell at 200, well, then you pay no taxes on any of that. That's awesome. That whole $100,000 of upside, or actually the whole 200,000 that you can distribute now, completely tax-free or continue to roll it down the road and continue growing it, that's, can certainly be a big benefit to people. You have a long time before retirement. These strategies, are either going to be very beneficial for people in kind of two different buckets. And certainly you could kind of phrase this and, put your own spin on it. But for individuals that are potentially having large amounts of offsets for your ordinary income, Roth conversions can be great because you can offset that additional income. And also for those of you that are younger and looking to kind of add chunks into this and continue to grow and convert at a lower rate, that can also be good because you can amortize your tax bill over a longer period of time. Where people typically see a little bit, I see less people doing it is people maybe, let's say, in the age of like 50 to 65. While I certainly do have plenty of clients that do that, it's definitely something that needs to be taken a look at with a much finer magnification, if you will, of seeing, hey, is this a good idea for me? Because if you do a conversion that bumps you up into two tax brackets and you have a $50,000 tax bill to pay, you have to pay that personally. And then you have to think about, okay, are my earnings going to, one, make up that $50,000 tax bill? And two, how much additional earnings do I have to get to a basis to where I would just been better off in a traditional IRA? I like to make sure people understand that the tax-free carrot that dangles for the Roth IRA maybe isn't worth the squeeze to chase it for some people, but it is important to understand everything holistic, in a very well-encompassing fashion to make sure that this is a good fit for you. And I don't try to be overly dramatic with this, but when it comes to taking on large amounts of income, it's very important to kind of look at this very carefully. Again, so you have losses to offset income for your conversion. Estate planning reasons, while the changes in 2020 definitely kind of removed or stripped back a lot of the benefits to the inherited IRA in general for non-spousal beneficiaries, if you are of the opinion that you'd like to leave your heirs something that is not going to burden them with any taxes, having a Roth IRA and converting it, if that's a benefit you'd like to give to your heirs, would certainly be a great thing to do. And keep in mind that you would be the one paying the taxes, but being able to give your heirs something that's not going to be of any tax burden, would certainly be nice. I certainly wouldn't mind getting an inherited Roth IRA at any point in time. And I have a little bit left before I turn it over to Corey, but I want to make sure I clear up any of the questions before. Let's see. So during conversion, can you pay the taxes out of the account, or do you have to pay them outside of the account? You have to pay them outside of the account. Otherwise, you will be getting double taxed on having to take a distribution to pay for those for that tax bill, because it's a personal tax bill you get. Anything you take out of the retirement plan could potentially have taxes as well. So paying them out of the tax qualified funds, while maybe functionally you could do it, is not something that I think in 12 years I've ever actually seen someone do. So to clarify, if both myself and my husband are over 59 and a half, then the 5-year issue is moot. No, you do still remember the conversions are going to age for the earnings on the conversions are going to age for 5 years, but to consider the converted basis for the purposes of distribution, to be able to distribute parts of the conversion as basis, the earnings have to be aged, but your converted amount is considered basis. So maybe not as irrelevant for that some might think, but it still is a factor. I think I answered the 60 plus, there's never a 5-year rule. No, there's definitely still is, and it can depend on a little bit on your current situation. Yeah, with regards to probate, you're good, it's just going to be considered of the value of the retirement plan at the time of death. As far as the underlying basis that would be looked at, that's definitely a question more to do for a tax planner, because it's not something I really necessarily get into or would feel comfortable speaking to. And then lastly, I'm already 58, so I technically be able to withdraw in less than a year and a half if I convert to a Roth. Are you saying I would not be able to take a withdrawal until I'm 63? No, you could take a withdrawal, but you wouldn't be able to touch the attributable earnings to the converted amount for 5 years. So let's say you converted $100,000 and you had $10,000 of attributable earnings. You could certainly distribute a chunk. Let's say you wanted to distribute $20,000. That would be tax and penalty free. But then you would have to keep in mind that you would have $80,000 of basis left and $10,000 of earnings you could not touch, and then continue to track that for 5 years, because those earnings attributable to that original $100,000 conversion do have to, again, remain and age for you to touch the earnings, because you always touch contributions first, then converted amounts, then earnings in Roth IRAs. I know it's a little bit kind of a heady thought process to go through with regard to ordering rules for Roth IRAs, but we're certainly happy to go through them in a little bit more detail, maybe after the presentation, if you want a little bit more of a specific look at the at your current situation. And actually, I do have one more slide. So why not convert to a Roth IRA? Again, you're close to retirement and you're not expecting significant growth in asset values, because remember, you got to pay taxes on whatever you're doing. So if you're close to retirement and you need more of your capital because you're going to be reducing your income, you're going to be living on a fixed income, to float a $10,000, $20,000, $30,000 tax bill might not necessarily put you in the greatest position financially. So again, getting towards the age of retirement, if you think you're going to be in a much lower tax bracket in retirement, maybe getting that additional tax deduction now to reduce your paid taxes and then having that marginal tax in the future might not be so bad. However, one thing that we can all agree on is that taxes typically go up and to the right. They don't historically really adjust down, and if they do, they don't do it for very long. The asset values in your IRA are inflated, and you're expecting the values to decrease. So let's say you owned a real estate portfolio in your IRA that has done what all real estate has done in the past 3 years, and again, done a hockey stick up and to the right. March of 2020 to now, got greatly increased values. So maybe waiting for a market correction that could potentially come to do a conversion at a later date would potentially save you taxes on that. You have to pay these burdens personally. So if you don't have available cash, or maybe you're not in a position where everything is not as liquid as you'd like, you have to pay that tax bill personally. So keeping in mind that you have to have the available liquidity personally to pay the tax bill relevant to this conversion is definitely something to keep in mind as well. And again, you have to be able to understand that the additional income that you see could reduce the ability for you to claim additional deductions, such as a child care tax credit, Medicare premiums, all these kind of things that maybe are dependent on your current income levels could be adjusted or could be removed from the benefits of you as a taxpayer if you take in a large sum of converted value as a taxable burden for that given year. And again, if you want access to the funds in the next 5 years, dependent on your age, that could be definitely something that you want to keep in. And with that, I will turn it over to Corey to bring us in for a landing on everything. Corey?
Yep, thank you very much, Alex. So we're going to pivot here for the remainder of the webinar to kind of cover the actual logistics and what you need to do to complete a Roth conversion. So the two key things that you're going to need are going to be a fair market valuation, typically from a qualified third-party independent valuator, and the documentation to actually transfer the asset ownership from your traditional or tax deferred account into the post-tax account. So I'll break that down a little bit more thoroughly, and definitely have some other similarly aligned educational content I could point you in the direction of. But just for context and purpose, the fair market valuation is a very simple, pretty much a one-page document that we have at Advanta. It just outlines what the asset is, what the current value of that asset is as of a set date, and then also the signature for yourself as the account holder and the valuator to provide. Now, when we're talking about certain types of assets, real estate was one that was referenced earlier in one of the participants' examples. You do need to get a certified appraisal done of the asset within 30 days of when the Roth conversion is conducted. So certified appraisal needs to be done. In theory, that needs to be fully executed, paid for out of the retirement account, because the retirement account owns the piece of property that's being appraised. And also the quitclaim deed needs to be drafted, prepared, and ready to be executed by the time you're turning in all the paperwork to do this Roth conversion. So if you're a client of Advanta preparing to do a Roth conversion of a piece of real estate, you would provide us the fair market value form, your certified appraisal, and also prepare your Roth conversion form, which is a simple one-page document we have. and also the quitclaim deed that indicates the ownership of the asset going from your traditional account into the Roth account. We take all that in, facilitate the Roth conversion, and then send out that quitclaim deed to be executed. We'll coordinate that with you directly as the client, but that'll be provided to you to go have executed and drafted at your local jurisdiction, whatever county or region you're in for that recording to take place. Now, a lot of times with non-real estate assets, that third-party appraiser can be an attorney, it can be a CPA. Obviously, in some cases, it has to be, again, like a qualified intermediary or someone that actually has specific use case and knowledge for the type of asset like real estate. And even if you're in, let's say, a syndication investment as a limited partner, someone from the general partnership team can be the valuator there. Another option, as Alex referenced earlier, we've seen investment providers help clients at the end of a calendar year structure converting their assets through Roth over the course of 2 calendar years. So in the past, we've seen people that are in limited partnership syndications do a partial conversion in December, and then right after January 1st takes place, they do the rest of the conversion, so that stretching across 2 calendar years and 2 tax filing years, these clients have converted the full value of their asset in kind from traditional to Roth. So again, just something to be aware of. Make sure that's why we're having this webinar and this educational content in early to mid-December, that you know that these options are available to you, and it's kind of up to you to do your own due diligence and decide if it's a good strategy. Breaking down a little bit further, real estate must have an appraisal done on the property, qualified real estate appraiser. Notes, typically just the outstanding principal. So if you have an amortization chart, we're just looking at what that chart says as far as how much has been paid back, what the interest was, and either the borrower or a CPA or another tax professional can be the appraiser or certified valuator there. For LLCs, an officer of the entity or someone that actually has some sort of managerial responsibility. And then if you have another asset that doesn't fall into any of these categories, contact us. If you're an existing client of ours, ask your client account manager. If you're not an existing client, reach out to Alex or myself, and we can definitely give you more insight. If you go to our YouTube page as well, I believe last year, if not the year before, I put out little 2-minute videos on every type of asset class and what the proper fair market valuation should be. I even walk you through how to fill out our form. So check that out on our YouTube page if you're interested. I'm going to be doing another fair market value webinar come turning of the new year. So that will be out, I believe, early February is when I'm doing that educational content. So to convert or not to convert, everyone's situation is going to be different and unique. Obviously, we answered some questions here today, but we don't know everything behind the curtains of what you as an audience have on your plate. So consult with your own professionals. There are conversion calculators to assist you with making this assessment. You can search those online. I'm not sure if the IRS website specifically has one accessible, but they are really good with providing some content and helping you know exactly what you're trying to accomplish. So check into those if that's something of interest to you. Age and projected returns are the most important factors here. Again, as Alex stated, and as I've stated, take a forecast of how long you expect to continue working before you actually start to retire, what your use case is going to be for the funds at the point that you retire. If you're someone that is going to do a Roth conversion and you know that 5-year seasoning or vesting period is at play, how much of that money are you going to need to access? Is it going to be viable with the waterfall chart of your basis into the account, your attributable earnings, and those different factors involved with how you're able to tap into that money and access it without any additional penalties or fees. Splitting the tax bill. Again, that's why we did this webinar at this time of the year, to make sure you understand that. And don't miss the deadline, December 31st. That does end up falling on a weekend this year. So if you are someone looking to set up an account and do a conversion, reach out to us as soon as you are willing to have that conversation. Our application in itself really only takes people about 15 minutes or so to complete. With help from Alex or I, you can get the account open basically the same or the next business day, depending on when we have that conversation. And there is typically a timeline of about a week to a week and a half for getting your account open, getting funds moved into it if you're currently with another retirement custodian, and then doing that Roth conversion as I cited a page ago on the slide deck. It really can be done as well within about 1 to 2 business days. We just need to make sure all the paperwork is provided and in line accurately to conduct the Roth conversion. With that being said, we're pretty much concluding here for today's webinar. I'm trying to just check the questions box if there's any new questions since Alex covered the last few. If
Yeah,
an
there's a
FMV has
couple.
already been established, oh, sorry, go ahead, Alex.
Yeah, there's a couple. I think chiming in at 12:35 is the timestamp if you want to take those last couple.
Yep, that's what I was just starting to read there. If an FMV has already been established and recorded in the account under the FMV, would I need another one prior to the conversion? Yes, typically that FMV needs to be within 30 days of the conversion of any asset in kind. So even if you did one 3 months ago, 4 months ago, you've got to get a new fresh one turned in to do the conversion. Is that just the FMV form? I believe I probably answered that for that individual when I covered 2 or 3 slides ago. It's the FMV form plus the supporting documentation, and specifically the executed signature from a qualified third-party valuator. I think you just answered it. The answer is yes, there needs to be a new FMV. Yep, got it. What are the fees for opening a Roth account? Our standard application fee is just a flat rate as of right now. That is $50. Again, you can ask Alex or I. We are more than happy to provide you our full application packet and our fee agreement to look over at your own discretion. We can answer any questions about our fees. I'm not going to dive into the nuances of all of our fees here on this call because it may change in the future and you may be watching this on the recording later on. So just reach out to Alex or myself and we will be able to provide you our application and the fee agreement so you can look that over. Would it make sense to roll an old 401k to a Roth or a traditional, currently age 51? I would say it would certainly make sense to do a rollover out of an old 401k to a Roth or a traditional. That side of it's up to you to decide whether you want to do the Roth conversion or just move it to a traditional. But in general, when you're talking about an old 401k, that's money that's sitting in a plan that is either being invested for you, or there is a context where once you leave a job, they're allowed to take you out of the profit sharing from that 401k plan and just keep your money until you tell them you want to take it out. So I'm not saying that's the case for every single former employer plan, but I have seen former employer plans where someone left a job and let that money sit with that account for another 5, 6, 7 years, and their money didn't grow at all after the point they left that job. So there's definitely something to be said to doing a rollover. Now, the side of it of making a Roth conversion or not, hopefully this webinar has given you enough input and discretion to make that decision yourself.
Yeah, I think you covered that pretty well, Corey. The only thing I would just, again, make sure that we're clear on is that a clear, especially for real estate, it has to be a clear independent third party. It can't be a comps from a realtor. It has to be a certified appraisal of the piece of real estate. So just keep that in mind, and it has to be dated within 30 days of the actual conversion date, because the requirements for evaluating an asset for our annual valuation requirements are much less cumbersome than doing a Roth conversion, because that is a value for taxation purposes that's being reported to the IRS, as opposed to kind of an administrative value, just kind of a tracking value that we have to do on the interim of that. So I would just like to make sure, especially, that we're very, very clear on that, especially if you're trying to maybe get something done next week. It's not a tax bill that shows a fair market value. It's not a comps. It's not Zillow. It's a certified real estate appraisal. And again, if you hold things through an LLC or you're invested in maybe a trust or something else, the kind of the standard for what we need is always going to change a little bit. All this stuff is very kind of unique in and of itself. So the best thing you can do, give us a call. We're happy to help you out. And we just got one says, does Advanta do all of the calculations for Roth and traditional withdrawals? And do you alert the account holder that their 5-year rule has been met and they will not get a penalty? No, we do not track underlying basis. And unless you have a dedicated financial advisor at a larger firm, typically no one else does either. That is something that is the responsibility of the client, is to track your 5-year aging basis rules. With regard to required minimum distribution, distributions for pre-tax retirement plans, yes, we are required to calculate that against the value that you have provided to us and provide you with the appropriate amount of required minimum distribution as calculated against that account for specifically a pre-tax retirement plan, such as a traditional SEP or simple IRA. Someone did have their hand raised. If you do want to chime in, keep in mind you are muted, so you would need to type that in. We'll stick it out for here for a few more minutes to see if anyone else has got any more questions. But other than that, that's pretty much what we got for you. So again, we'll stick around and see if maybe that hand raise wants to chime into the questions and we'll get it answered. If not, we'll button this up here in a few minutes.
And just for the audience, just to add and kind of fill some dead air here, what Alex was just referencing about the appraisal for piece of real estate being converted, it makes sense, right? Because if you're looking at like a certified market analysis, that is something that's not as set in stone as a certified appraisal, and it can be manipulated either up or down based on the comps that you're providing in that analysis. So the IRS is really looking for a black and white number to value this asset because they're trying to collect taxes on that black and white number, and they don't want the ability for someone to manipulate that number down, as kind of used in the example from one of our participants today, manipulate that number down, Roth convert the property, and then sell it for a relatively inflated value right after that's been done. They're trying to avoid that being an applicable situation. Again, if someone is able to accomplish that, that's great and good on you. But that's kind of the purpose that the certified appraisal is required in these scenarios.
All right, well, I don't see any more questions chiming in, so I think it's a good as place as any to button this up. Thank you, everyone, for joining with us today. I always appreciate getting to tag team these things with my colleague, Corey. It's been a pleasure. Anything else before we end on this thing, Corey?
No, I think we've covered everything. Again, if anyone has any specific questions, please feel free to reach out to us. If you're an existing client, reach out to your account manager. Check us out on our next webinar. I believe we may be on a hiatus right now until after the holidays. So I hope everyone has a great holiday season, and we will see you back either at the end of this year or early next year. Thank you so much.